This is the bit you've all been waiting for. Right. This is a client of ours. The only thing we've changed is the name. Right. Let's have a look. Do I like that? Can you see this? No? What this is, can you see the numbers? Alright, okay. Operating loss, 2009, £15,000. Does that mean he pays tax? Well, you can tell here, it's got a tax there. Taxation. Let me just stand here. Taxation, 0, 0. Doesn't pay tax. It's got a loss of £15,000. Loss of £21,000 in 2008. That means he's got a cumulative loss of £36,000. So this is a guy who came to me with cumulative losses, £36,000. And that's his profit and loss account, year ended 31st of October 2009. This is his balance sheet. So what happened? In 2008, he's got net current liabilities. That means he's technically insolvent because the creditors exceed the assets. 2009, positive 14,275. Long-term liabilities 337. Negative balance sheet £36,000. So that was the set of accounts that came to us. We were asked to do the accounts for the year ended 31st of October 2010. Anything funny about that P&L?
Restated 2009.
Sorry?
You restated 2009.
Yeah. What's happened here? What's happened here? That doesn't make sense. The 2009 comparative figures come from the 2009 accounts last year. Why is that figure different? Let's have a look. Go back. 2009, cost of sales £41,000, turnover £68,000, gross loss £23,000. They came to Wilkins Southwark, and what's happened? £204,000 loss.
What's the price of the house on it?
No. That is a prior year adjustment. And what that means, the guy came to me and he actually said, the reason I'm changing accountants is because I can't bother asking my accountant any more questions because he never knows any of the answers. And unfortunately what happened is he prepared the accounts without taking account of everything properly. What he'd done is he bunged a lot of stuff in the balance sheet which is justifiable profit and loss expense. That's what I'm saying, is you wouldn't necessarily know. So what we did is we rolled our sleeves up and we found expenses of £269,000 in 2009. So that's gone up £220,000. Same set of accounts, nothing changed from last year. But what you've done is you've moved it from the balance sheet to the profit and loss. £220,000 at 20% is £44,000 tax saving. We've probably done 5 of these just with the HMOs, PPP businesses, where accountants weren't aware of what you can claim. Mainly capital items that shouldn't have been capital. So what that means is then he's got a loss of £245,000. And how can you do that? You can do what's called a prior year adjustment, which is an accounting adjustment that says you have a material adjustment for last year's accounts. That loss gets carried forward to 2010 under there, prior year adjustment. In that case, £299,000 prior year adjustment.
Chris, would something like that, given the extent of the change, would that create a query with HMRC?
Can you repeat the question? Chris, can you repeat the question?
I can't none of the questions.
Right, okay.
It depends. If it does get questioned, so what?
You've got the answers.
You've got the answers, or else you wouldn't have done it. But the point is that these 5 people all came from 5 different accountants that didn't know how to do it. And the client wasn't even aware how inaccurate the accounts were. What happened is that they made that expenditure They knew it had gone out, but where does the expenditure get treated in the accounts? Is it a balance sheet item? Is it a profit and loss account? If it is a balance sheet item, can you claim capital allowances? If you claim capital allowances, can you get AIAs at 100%, writing down allowance at 20%, next year 18%? What relief do you get on your money? This type of thing is the difference between getting a really good job for your client or just doing an average job, but does the client actually know? This is the type of thing where you actually can benefit from a good account. What's that? This is the bit that you've all been waiting for. Sorry.
Right,
Go back.
no, it's not about completely what it is, but one account to another, they both I believe is the correct answer. It's kind of subjective. You know, one person calls it capital, the other person calls it debt. They both completely convinced about the correct way of accounting for it. Is it subjective?
Yeah, but it's no different if you go to a doctor. The doctor says X, and you say, well, I want a second opinion. And the other doctor will give you a different answer. It's no different. You go to professionals, and different professionals do different things. You could say, well, do you go to if you've got a problem with your head, do you go to a general practitioner, or do you go to a consultant? I mean, we as a practice don't do, say, I do Lloyd's insurance accounts. That's a specialist thing. Some accountants just do general practice. If you concentrate on this type of area, you build up a specialty.
That's fine. If that's
I happened to have a conversation with this accountant at the request of the individual, and the accountant basically admitted to the fact that he wanted a quiet life. It wasn't that it was necessarily right or wrong in his view. He had in his mind a ratio of what he thought he could get away with, and if he stayed within this ratio, he wouldn't get a tug from the HMRC. Therefore, he was acting in the best interest of his client, because if he stayed in this ratio, he was probably safe and wouldn't have to answer the case. And of course, the ratio is an irrelevance. It doesn't appear anywhere. And so all it really meant when he was pushed on it was that he wanted a quiet life because he didn't want to have a battle with the HMRC.
And also, back to earlier, are you happy to have inquiries with the revenue? Yes. Do you challenge it? From our point of view, yes. Do you go to general commissioners if they argue with you? In our case, yes. Have we ever lost the general commissioners? No.
Chris, can you give an example of the nature of the type of expense that went from capital to expense? Was it a
yeah, I can give you a simple
conservatory
example,
or
if you look at something like the property income manual, what it will say is things like, if you replace single glazing for double glazing, is that capital or is it of a profit and loss expense? Well, in the old days you say, well, there's an improvement element. If there's any improvement element, then therefore it's a capital nature because you've improved it. But by concession, the revenue accept that common practice is double glazing. If you accept it's double glazing, then it's classed as a repair, so it's not capital. But if you don't read the property income manual, you won't be able to give an answer.
Yeah, I mean, just tracing this back to how it started, I had an accountant called Jim Robertson, and then I met Chris through Richard, and basically Chris made me aware of capital allowances. I went to Jim, and he said, no, I disagree with that. So I had a three-way conference call with Chris, with Jim, and myself. I listened to the balance of the arguments. Chris then showed me the tax documentation that supported what he was saying. I changed my accounts from Jim to Chris. I've been with him ever since. I then had an HMRC investigation into everything, and basically it was ratified that the way everything was done from a tax point of view. I remember you phoning me up saying, Steve, good news, HMRC have kind of approved it, whether it's case law or whatever. We've got a precedent with my own accounts that what you've done and what he does for most franchise partners goes through from an HMRC.
Yeah, what you've got to do is that we had one, I remember, furnished holiday let, and you've got to say, well, what's the requirements for furnished holiday let? Well, there's really only three requirements. You've got to be available for let. This is in those days, they're also changed, but in those days, you'll be available for let 140 days, physically let for 70 days, cannot be let to one person for more than 30 days. So what happens with the furnished holiday lets, you can create big losses because sometimes it's not possible to have a trading profit on these things. If you have big losses, the great thing about Furnished Holiday Let, you can offset the loss against other earned income, and you can create tax refunds for that. And we did it with great alacrity for these clients. We got big tax refunds, and this revenue inquiry was started on the client, and they started off with the usual questions which we responded to, and then they sent probably 5 pages of questions, and including we want business plans, we want business reports, we want a summary of how you ever anticipate making a profit on this property, all of which are very interesting questions, but none of which actually comply with legislation. Legislation doesn't say you have to have business plans. Now, you could sit there for months and incur loads of fees answering the questions, or you could do like I did and go back and say, we don't have to answer those. The reason you don't have to answer them is not the legislation, which didn't really go down very well. So then what happened is that I said I want a technical review by your technical officer. So the district technical officer looked at it and he said, I agree with the inspector. So then I started rolling my sleeves up because it's a bit annoying because I don't know their own legislation. So then we said, right, you better send it ready for general commissioners. So once you got lined up for the general commissioners, they got someone else involved, and he wrote back and said, we're closing the inquiry. Because none of those questions are valid. But if you don't know what the legislation says, you'll be spending all your time, and your accountant will be spending all his money, your money, answering the questions which aren't even valid. And then once you get into those questions and answer them, he'll then take you down a path you shouldn't even started on. But you need to know what paths you go on and choose your battles.
So have you covered the, just in simple terms, the benefit of doing it this way? Because some people, certainly the newer guys, just look at that and think, I'm going to be running a business making £250,000 loss.
The benefit is this year. That's a prior year adjustment. So prior year adjustment is in that case corporation tax. If you were a basic rate level corporation tax of 20%, £60,000 is what it will say to you, corporation tax £60,000. This is a guy that went to an accountant and saved himself probably 500 quid. So that is the difference. Like I say, you can go to different accountants, you'll get different answers. And it's up to you where you go and how you do it. But that is an example, something like that we've done 5 times. And that means that loss to carry forward, 248,000 is the tax loss, but it's not far off it. So that guy is going to go quite a few years before he starts paying tax. And that's a set of accounts that hasn't changed. You spend exactly the same money. He hasn't spent any more money doing it. All that happens is when you allocate the figures in the accounts. But if you don't know where to allocate them, you don't know whether it's done right. Any of you that thought that accountancy was far too interesting? This is just for fun. Anyone can tell me the answer? You get a prize. Anyone knows what it relates to? You get a prize. Can anyone see it? Right. There's no way I'm going to start explaining that. If you can't see it, you have to walk to the front. What it is the double taxation treaty calculation between Switzerland and Great Britain. And that is the way you work it out. Out of interest, has anyone done one of these? Yeah. We haven't done one yet. It will be interesting if we ever get the double taxation treaty with Switzerland, we have to do it. But that is the new agreement that the revenue comes to the people who have money in Switzerland and how you calculate your UK tax liability on it. The Swiss Convention, it's called. So, if ever you can't sleep at night, by all means take a copy of that and try and work it out.